If you are driving for Uber, Lyft, or DoorDash, you are probably leaving at least $2,000 on the table every single year. Most gig workers just look at the summary their app gives them and call it a day, but that is a massive mistake that's costing you rent money. Today, we're breaking down why the mileage deduction you're taking is likely wrong and how to fix it before tax season hits.
It's a huge issue. I've seen so many people on Reddit lately, like one driver who netted 62,000 but owed 15,000 in taxes. They were asking, how do some people pay nothing? The secret isn't a loophole, it's just knowing how to do the math between the standard mileage rate and actual expenses.
Before we dive into that math, I want to hear from you. Comment miles if you use an app like Stride to track your trips, or paper if you still use a physical notebook. I want to see which one the IRS is more likely to challenge.
Okay, let's get into the basics. The IRS gives you two choices for deducting car costs. You can use the standard mileage rate, where you get a fixed amount for every business mile, or you can use actual expenses, where you track every receipt for gas, tires, insurance, and repairs.
Most people just go with whatever sounds easier, but there's a fear factor here. People are terrified of an audit because they guessed their miles, or they worry they're missing a $5,000 deduction because they lost a gas receipt.
Exactly. And here is the first major rule from IRS publication 463. If you want the option to use the mileage rate, you must choose it in the very first year you use that car for business. If you start with actual expenses in year one, you are stuck with it for the life of that car.
Wait, so if I buy a car for DoorDash and claim my gas receipts the first year, I can never switch to the per mile rate?
That is exactly right. You lock yourself in. And for 2025, the IRS just raised the business mileage rate to 70 cents per mile. That is a huge jump from previous years. It means for every 100 miles you drive, the IRS assumes it cost you $70, even if you're driving a fuel-efficient hybrid that only cost you $10 in gas.
Quick poll for everyone watching. Is your car a gas sipper like a Civic or Prius, B, a gas guzzler like an SUV or truck, or C, an EV? Type your letter in the comments. Your method choice depends 100% on this.
Let's look at a real-world dollar example. Imagine a DoorDash driver in a 2020 Honda Civic. They drive 15,000 business miles in 2025. Their actual costs for gas, insurance, and maintenance total about $6,000.
Okay, so if they take the actual expenses, they deduct $6,000. What happens with the mileage rate?
Using that new 70-cent rate from IRS Notice 2025-05, 15,000 miles times 0.70 equals a $10,500 deduction. That is $4,500 more than their actual costs. If they're in the 22% tax bracket, they just saved over $2,300 in actual taxes.
That is incredible. The standard rate wins because the car is cheap to run, but the IRS gives you what I call a luxury credit. But where do we actually put these numbers?
You'll use Schedule C of your Form 1040. You put your car expenses on line 9, but you also have to fill out Part 4, where you tell the IRS your total business miles, commuting miles, and personal miles.
Speaking of commuting, that's a trap, right?
Huge trap. According to publication 463, driving from your home to a regular workplace is never deductible. For gig workers, the miles from your house to your first pickup usually count as commuting. However, the miles between deliveries are fully deductible, even if the app isn't active. Also, don't rely solely on the Uber or Lyft summary. They only track on-trip miles. You are allowed to track the miles you spend driving back to a busy area after a drop-off, but you need a contemporaneous log. That just means a record you kept at the time of the trip.
So, step 1, start a log today. Step 2, calculate your 2025 miles at 70 cents. Step 3, file that Schedule C correctly. If you need more info, look up IRS publication 463. Share this with your delivery driver friends. Most of them are paying 15% too much in tax because they're taking the wrong deduction.
Just a reminder, I'm an educator, not your CPA. This is general info based on IRS publications, not personalized advice. Situations vary, so consult a tax professional about your specific circumstances.